And welcome back. As previously mentioned, we're going to take a deeper dive into four methods of analysis that's going to help us get an understanding and make decisions. And two of the methods, the net present value and internal rate of return methods, are based on a time value of money, taking future cash flows and discounting them back to today, or coming up with a rate of return anticipated based on those cash flows. And then there are two non-time value of money based methods of payback period and accounting rate of return. And we're going to take a look at all four of those in this video. So if we look at the phases of project cash flow, there's an initial outflow, initial investment, where we start the operation or start the project. Then there's the ongoing operations, and that's the cash flows associated with receipts and expenditures during the life of the project. Then we have the disinvestment. At the end of it all, there might be a salvage value of equipment. There might be a way of getting some return on the investment in the end of selling off assets, and recovering some of the working capital. So we have three sets of cash flows to be concerned about. So let's take a look at a limo purchase, or considering a limo purchase. We have the actual outlay up front of the limo purchase, plus the working capital needs up front. We have the operations. We're going to have revenues less cash cost. And again, it's all cash based. It's all cash flow based. So we have fuel and maintenance, insurance, and we have a driver salary. Net annual cash flows after revenues less expenses of 28.1. And then we have the disinvestment. There's a salvage value of the limousine at the end of the 4 years. And we also have a recovery of some of the working capital associated with that at the disinvestment phase, or the sell-off phase, or at the conclusion. So how do we calculate the net present value? Well, we add the present value of all the cash flows, the project's cash flow, the disinvestment cash flow, those are future flows, and we subtract the initial investment in today's dollars. You did this with bond valuation. We had two cash flows. We actually had the bond at its maturity that we got money back. If it was a $10 million bond, 10 years at 5%, we paid $10 million 10 years from now. If we had interest that we paid, so 5% of that 10 million, maybe we paid it twice a year, that's cash flow twice a year, also known as an annuity. We had to discount those cash flows, both of those sets, to get to today's value of the bonds. Well, we're going to do the same thing to evaluate projects. So we're going to adjust for the time value of money. We'll have a discount rate, which is usually the minimum rate of return required for the project to be acceptable. And we'll see what that cash flow looks like. And if it's the higher the rate of return, the smaller the actual dollars of today's dollars would be the net present value. And sometimes if it's too high a rate, or if the project doesn't pay, we'll have a negative net present value, which means don't do it. So our assumptions: initial investment occurs at time zero. So we get today as we make the investment. All the cash flows are at the end of each year. So we are annualizing and taking end of year valuation of those cash flows. Initial investments a lump sum today. Operations treated as an annuity if equal in amount each year, and they could be varied or they could be the same. So annuity if they're equal. Otherwise, we have discounted cash flows for each of those different dollar amounts back to today. And finally, the disinvestment. And as I said, it was similar to when we did the bond analysis previously. And we used the tables before, and you want to be able to use tables. We look at the present value factors, or the PVA, present value of annuity. And the present value of today is a 1.0. That's the money went out today. Then we have the PVA, present value of annuity, for 4 years, and then we discount the cash flow from 4 years back to today with that, in this case, 0.73503 rate. And we have a net present value positive of 16,126. So positive means, yeah, it's probably a good shot for an 8% investment, or if an 8% expected return, we're going to be positive as that goes. Here's the cash flows, present value, and we can do it on a spreadsheet. And again, table, spreadsheet, financial calculator, whatever it is, that's going to give us the results. Okay. There is a caution. The first cash flow accounts at time 1 rather than time 0. So you admit the time zero cash flow in the formula, and you range top to bottom or left to right in the rows. So it's just a little formatting thing when it comes to a spreadsheet. Now we got something called internal rate of return. We're not actually calculating a present value dollar amount. We're actually calculating what is the rate of return of this investment as a percentage. And the discount rate that equates the present value of the cash inflows to the present value of the cash outflows. So where we have a zero NPV, we're going to calculate a percentage rate. It's almost like a break-even analysis that we're doing in managerial accounting. So this is a zero net present value. What is that rate of return that we are anticipating? And the minimum rate that could be paid for the money invested in a project without losing the money. And again, NPV would equal zero based on that rate. And we could use a spreadsheet approach also here. In this case, we had our outflows and our inflows, and we had a 0.156 or 15.6% internal rate of return. In the spreadsheet, by the way, you need to give it a seed figure. You have to give it a seed number. You started with 0.08. Doesn't matter what you really start with. It will effectively give you the same result pretty much as you go. And so the internal rate of return should be compared to the required rate of return. This is 15.6%. Is that good or bad? Well, it depends. And it depends on what your cost of capital is, what your anticipated returns are, and what your investors want for a return. But this is at 15.6%, which is a heck of a lot better than the 8% that we were trying to use for our net present value analysis, which did come out positive as well. So we knew it was a higher internal rate of return than that. Cost of capital, consider such things as the effective interest rate on debt, effective dividend rate on preferred stock. So what is the organization's cost of capital? What is it you want to obtain or expect to obtain and the returns that you desire? And a company cost of equity capital, you have the current annual dividend per common share and the current market price per common share plus a growth rate. So investing in a project that has an internal rate of return greater than the cost of capital should increase the market value of the firm's securities. So the stock should go up. If we're making more money than someone who's just investing and has a certain return based on dividends or based on what they were getting from the company directly, if our internal rate of return exceeds that cost of capital, we should be in pretty good shape. So let's go ahead and take a look at two of the non-cash flow present value. I'm sorry, they take care of cash flow, but these are non-present value methods, do not take into account the time value of money. And one is a payback period. And bottom line, it says how long I've got my investment, I've got my revenues or my net revenues minus expenses, my net income for each year or cash flows from each year. How long is it going to take before I actually break even on that? What's my payback period? And that's to cover the initial investment. I mean, this investment, the limo might go on for 10 years, not 4 years or 8 years. We haven't determined that. And possibly we're saying, well, what's our payback period? How long before I pay for the limo? And acceptable projects must have less than some maximum payback period as determined by management. But we are not considering time value of money in our analysis. So what's the payback period? Well, we take our initial investment, we divide that by the average annual operating cash flows. In this case, 86.5 divided by 28.1, and in just over 3 years, we'll have the 86.5 covered. Then after that, it's going to be, that's the gravy, that's the profit, that's past the initial payback period. When you have unequal annual operating cash flows, we have to go ahead and figure out each portion of, well, the cash flow in this year was that, it was a little bit more the year after that, a little bit more the year after that. So we're getting down to it's over 3 years to get our cash flow because we had different cash flows. So we couldn't just use a straight division. We had to do individual analyses on this table for each cash flow. And let's talk about the accounting rate of return. The average annual increase in net income that results from accepting a proposal divided by the initial investment of the average investment in that project. So the average net cash flows from operation minus the annual depreciation, we're going to take out the depreciation as an adjustment, a non-cash flow item, over the average annual increase in net income. So that's going to be a rate of return that we calculate. And the example here, 28.1 is the annual net cash flow from operations. We're going to take out the depreciation of the initial expenditures, average depreciation, average annual increase in net income it's an after depreciation increase in net income that's calculated. And we have that 10.1 out of the 84,000 initial investment, and we get 12%. Average rate of return on the average investment, though, we're going to take that average now, and we actually have a 21%. And if we do not exceed the minimum required return, we're going to pull back and not make that expenditure, not make that investment, and go from there. We'll be following up and taking a look at some of the advantages and disadvantages on our next video. Thank you very much.